Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling and Sterling, Stephen Napolitano, The Wickoff Group, Urban American.
So how do you put four elder statesmen, how do you take four individuals who have seen 3 to 4 recessions together? I do it. And I brought these people to really provide their insight on how they look at the economy, the real estate market, and what's going to happen in 2012. I don't have my crystal ball, but perhaps I have my crystal guests. My guests today include Robert Levine, who's the president and CEO of RIL Companies, Fred Gould, who is the chairman of the board of BRT Realty Trust, the chairman of the board of One Liberty Properties, and a principal at Gould Investors. I have our consigliere, the eminent Leonard Boxer, who is the chairman of the real estate practice at Strzok and Levan. And last but not least, I have my very dear friend, Jim Orphanides, who is the president at Centurion Holdings. So, Brother James, since you and I always have these little discussions, and I'm happy that Freddie's here because we had that discussion prior to the show, how do you look at the world today?
Well, Michael, first and foremost, I want to put down the date. Today is July 20th, 2011. So what we say today is effective as of today, because who knows what's going to happen tomorrow. Anyway, right now, I think we're in a very big questionable period, because I think the headlines about the national debt and raising the limits is on the forefront of all of our thoughts. We want to see that being passed. We want to see a little less government. We want to see businesses encouraged to hire. President and this administration came into the White House and into the executive branch where the economy was the issue that put them there. The economy continues to be the issue. And the job market goes hand in hand with the economy. I don't see that these things are being progressed in quite
one day
a measurable way.
before I hear Goldman Sachs, the pillar of the economy, didn't earn their profits, and now they're laying off 1,000 people. This is not the first layoff. They're laying off another 240. So that's 1,200 people in a year that allegedly the world is great, especially in New York City. Lenny, you've seen enough recessions. Where do you see the market today? What are you seeing?
Well, the capital markets are dependent on Wall Street, and that's a big part of what we're dealing with now. I mean, there's like a hiccup in the capital markets today because of what's going on in Washington. And I think until that calms down and we see a positive direction in this country, you're still going to be in uncertain times.
But here is the situation. 2 years ago, there was no securitizations of mortgages. today you have everybody. You got Cantor, you got Perella just signed an agreement with Prudential to be in it. Everybody's back in the CMBS market. What do you attribute
Well,
that to?
there's a lot of money around today. The problem you have is people are like the deer in the headlights. They don't know how to make the move. I mean, you take a piece of property that gets put on the market. You used to shake hands with somebody, you had a deal. Now it's almost like the free agency in baseball or in sports. You have a property that's available, they put it out on the market, and you have a feeding frenzy because there's so many people running after the properties that have become available. It's a new ballgame.
So here's the question. For somebody who's owned properties, who's lent on properties, are these prices realistic? What's going on? I mean, some of these properties are selling for back to the 2007 numbers. Freddie?
I'm not an economist, so I can't speak to you
We're
about
not
the
talking about
economy. But just to the real property segment of the business, the business has changed. Rob and I were speaking before about this. The hordes of money today are primarily OPM, other people's money being run by individuals. Their term is limited. When we went in business, we still today look at how things are going to be in 10 or 15 years. It's more significant to us than in 2 or 5 years. The money today is in the hands of people who are looking at short term. The big money in our industry is either in OPM, where you're running money for institutions, or in large REITs. Large REITs today are selling at more than the NAV, more than the property values. If you took all the property values together, I think you'll find the large cap REITs are selling at a greater amount than that, so that they're getting money at extremely low coupons. I'm on the board of a large company besides our own companies, and I know our actual cost of money debt side is probably less than 2%. Our actual dividend payments out are less than 4%. Now, our FFO is even more acute. But when you have money that you can get at 4%, you can be a player at very large amounts of cash required. And you can always tap the market. Anytime you want more money, you knock on the door and they send it to you. They call these things ATMs now, at the market offerings. So you do an at-the-market offering at 4 o'clock in the afternoon, and you do $100 million, and they sell it, and you have the $100 million next day at the same price the stock was selling at the end of the day. This is prevalent all over the market today for real property companies. So you have pools of money going after properties that don't require what I would say would be a realistic risk-reward ratio in yield.
So how does somebody like Robert, who operates independent, who's dealt with OPM in other cases and who's worked with investors, how does he compete with a REIT?
Ask him. He's
Very
doing
difficult.
it pretty good.
It's very difficult. No, we've spent the past, I'd say, past year bidding on properties where we are constantly, outbid with no rational reason whatsoever. It's, as we said, you have fund money that's sitting on the sidelines that has a fuse on it that has to be spent. We look at properties and we look at what added value we can bring to the property. So there's an intrinsic value to our offer.
I mean, you remember we were talking a couple of months ago about a property which really didn't make sense that an Asian company bought. They had no idea what they were going to do with it, but they were lucky that the world changed. The world turned around. And then they sold it to somebody for conversion.
We were on that property. We were brought in by the institution, and we were working on the property to find a solution. And we recognized that the path they were on was really incorrect. And we said, we had a development agreement worked out and everything. We said, you need 45 days to give you a development plan that can really work and put this thing together. And with that, actually an individual who's a friend of mine who looked at it and said, he has the resources for offshore money, European money. He has a different set of parameters. He came in, he offered them a number.
Yeah, but apropos to that, if you have a domestic purchaser, the thing that has changed, and I think the lesson that was learned by the institutions or the lenders, is they're doing their underwriting in a much stricter way these days. It's not really putting a chill on the market because there's so much capital and equity available for deals. But what it's done is it knocked out a lot of the marginal players who always thought they could get 90% financing. That's a thing of the past.
But you know, it's interesting you bring that up. I recently did a symposium, and I had the investment banker from J.P. Morgan, and he said, we're doing 60 to 65, but we're committing for 80, and we have everybody jumping in to do the mezz. We'll take it on. We're not even a risk. We have 9, 10 players who want to take that 20% of the risk. Now, they're not getting 100%. But, you know, we were talking before, Fred and I think, you know what? In the 90s and the late 80s, you had these S&Ls who were wild and wacky and did whatever they want. In the early 2000s, we had banks like Chorus, Fremont, other place, builders, you know, these people who aren't there. Is history going to repeat itself in 2012, 2013?
When you focus short term, you get that. Because the guy who's there is going to make his money in commissions and things of that nature and payments for what he does in a reasonably short period of time. Very few of the people who made the big money at the institutions you're speaking of were there when the catastrophe hit or lost any money when the catastrophe hit. So as long as you have a short fuse mentality and reward program, you have to get
Great story. There was a person, they called him Big Loan Verone. He was at Wachovia, and he is now working for all his borrowers that he lent too much money to restructure their loans. And he said publicly at a speech and in front of me, he said, any loan that I did in 2007 does not work today.
That's true.
And I said, now you're pushing every one of the lenders that you did business with to give a discount. And I said, what happens 2 years from now? He said, I'll be back in the business of lending money. I mean, so...
I think that's a very honest
I'm not
perspective.
disagreeing.
I think he did a great credit to all of us to say what he did say, that in 2007 it might have worked, and today it doesn't work. Well, what does work well today?
So tell me.
You asked the question.
I mean, you're on a board of a private held REIT. He's on a board of a publicly held REIT. He's involved with all this. I mean,
ours is a public REIT, not a publicly traded REIT.
Okay,
That's
a
the
public REIT. So I mean, you have fiduciary responsibility.
Sure.
What do you tell people? You know, you have stock. You know, you have shareholders to report to. What do you say that's a good investment today? What is a good investment?
Well, we don't think short term. I think in answer to what Fred just said, when you said in a fiduciary responsibility, your obligation is to reward the stockholders, not just for this month or this quarter, but we want to reward the stockholders and the people that are going to be there from the beginning all throughout the many years that we hope that they will continue to stay with our company. And as a result, we continually look long term. We don't even think in terms of 3 years or less. We think in terms of 3 to 20 years. And we're hoping that we'll be able to go farther than that. And that's where, when you deal with the scales and you deal with competing with the REITs and you can deal with all the other things, they can scale things differently because they're not looking at it from simply a small base. They'll blend. It's like it's a different mixing bowl, and they'll bring things. We started out as an industrial REIT. Now we're both an industrial and office REIT, and we're going to continue to grow. But we never look short term.
Lenny?
See, but Fred put his finger on it. Today, you know, a lot of the funds, are looking at short term. They're not the traditional families, the traditional money that looks at deals for the long haul. They'll buy stuff that maybe doesn't cash flow today, but they look to the future. They're holders of these assets, and yet you have these funds out there, and all the institutions.
I'll give you a great example, and I didn't bring it up before, but Fred had a great building on Fifth Avenue that he sold to a fund, and the fund converted the building on Fifth Avenue, and everybody thinks that they did get $1,600, $1,800. The two funds who bought the project both made no money on the deal, but they all got fees. They got fees during the period of time because they were doing asset management. Mm-hmm. And everybody thinks that this property, which is in the Flatiron District, would be great, but it didn't work out.
So are you saying the investors didn't make any money,
The investors made no money.
but the people who were
They made the fees.
that
The
did
fees, the
investment
people
for them?
who were running the money, the people who were doing the conversion made the fees.
But did the fund pay its return anyway to its investors?
If you look at funds that were doing numbers in 2007 and 2008, and Lenny's involved because his son is one of the better funds, nobody made their true money. I mean, if you looked at debt funds, there were no debt funds.
But yet, if you had the patience and you weren't looking for the big hit, you had patient money, and you had a horizon that was not limited. Things are coming back, and that very fund you're talking about, it's going to be in the black.
I think the
Mainly
other thi-
because a couple of the properties, now almost all of the properties are turning around. And you also have to remember that many of these properties, they take write-offs and they write them down initially.
Correct. So they
And
took,
all of a sudden,
They're
that the
heroes.
market changes
They're
and they got a
heroes.
big uptick.
Right.
And
But
that's
that's looking back. You know, I think what we're saying is now looking forward.
I want
We're-
looking forward.
We're in a situation where we're competing also. You know, from our standpoint, we're competing with funds and REITs where a lot of the considerations are not there in the offer that only come with experience. How many of these people recognize where property taxes are, where operating expenses are on a property, and what it really is, what it's going to take you to get to a conversion if you're doing a conversion, what it's going to be, you know, what the TIs are going to be, what are you going to have to deal with? And it's just, you know, you start to see that it becomes something where to them, when they're bidding on a property, if you're bidding on a property for $120 million and you get into the second round and the second, you know, and somebody says you got to get to 140, it sometimes doesn't faze them to just jump to that 140. Whereas someone who's going to analyze that property and look at it from the real perspective says it doesn't work.
Freddie?
You can't look at real estate outside of the economy. I'm not an economist, I understand that. But I have learned in real estate that we're in a service business. We don't make a product that has any value in and of itself. We only make a product that has a value if someone else can use it for something. We make a box. If you want to manufacture in that box, the box has value. If you want to sell retail in that box, the box has value. If you want to make an office in that box or live in the box, it has a value. It has no value in and of itself. Someone has to want and desire to use your box. Now what's happened, so we have to be economists to a certain extent, because right now, not a hell of a lot of people want new boxes.
I'm going to ask you, One Liberty is a retail entity, correct?
Right.
20 years ago, there was a chain called Sam Goody. They were music stores. They were DVD stores. They were video stores. We lost Circuit City.
Borders.
Now we have no bookstores. So who is there to replace this?
Well, I can tell you what we try to do in One Liberty. We do two things which are somewhat old-fashioned. Number one, we don't have any mortgages that don't have amortization. We take no interest-only mortgages because amortization is like putting money in an insurance policy. As you reduce your debt, even if your property doesn't increase in value, your value of your equity goes up. The second thing we do in One Liberty, we don't base our investments on credit. We try to base our investments on real property value. We own the Fridays off the expressway, for example. When we bought it, had 2 years to go on the lease. No one wanted to buy a net lease with 2 years.
Yeah, but you were looking at the property.
They make a ton of money operating a food business there. So that we try to concentrate on what can you do with the box if the current guy goes busted. Now, if the guy is selling shoes, can the next guy sell drugs if the shoe guy goes busted?
But it relates, you know, and I did some research because I'm going to write an article about it. Industries changed. 20 years ago, we didn't have the warehouse clubs. But today, we only have 5, really. As we said, there were bookstores. There were no bookstores. People can't remember that it was only 10 years ago that the first Apple store was open.
Well, but Mike, I was just going to finish.
That's the
But
thing.
if you say, are we not worried about the internet, you'd be wrong. Our portfolio is now about 60% retail and about 40% non-retail. Are we worried about the internet? Yeah, people can't buy hamburgers on the internet, but you can damn well buy anything else.
I did a show on retail right after the retail convention. I had John Gutbetter of Americana Mall, and he said Williams Sonoma moved from Americana Mall. Great mall, one of the best in the state, one of the best in the country. He said because Williams Sonoma is gearing themselves now for more of the internet.
Right.
They've changed their business.
But, you know, Fred's being practical, and it comes back again. Retail, a lot of times, is when we've done lots of retail through the years, you know, and
You were the king of building wall bounce.
right, exactly. So the point is that, but it comes back to location, proximity to when you mentioned off the expressway. Those are all things that are practical, that you go back to the basic principles. A location, if it's great location, works. But why did the Apple Store work where it went? Why is the Apple Store, you talk about...
Look at the General Motors building.
Exactly.
Look how that site that's over in front of the building.
I mean, you had a terrible restaurant downstairs.
Right.
You know, with the cars downstairs.
All of a sudden,
you know,
it's the hottest place in
or
town.
you know, get an Apple Store in any location.
Right.
You know, at this point, but it still comes back.
Microsoft announced 75 stores they're going to open. 2 years ago, they opened up the first Microsoft. Now they're going to open up 75.
But there is a danger in internet to everybody else. If you have a cat or a dog and you want to get dog food, you don't have to go any longer to a store. You push 3 buttons and they deliver the stuff to your home. So that's going to affect retailing. People tell me it's not affecting it that rapidly, but percentage-wise it is.
But as at the same time, you look at that and you use that segment of the retail industry, and you look at Petco and these different kinds of stores. They're opening more and more of these larger stores because the number of people with pets is increasing. The amount of money that people spend on pets is increasing, and all of a sudden you have these. You know, it's unbelievable. We're doing some design work for guys in the city now that are opening these places all over. You know that.
I mean, my favorite example is Dwayne Reed.
Oh,
Dwayne Reed today in new stores in Manhattan are 16,000 to 22,000 square feet. They opened up near Lenny downtown.
That's right.
A 22,000 square foot store with the dock in the box, with the food, 5,000 square feet of food, all fresh food, a nail salon, a hair salon. I mean,
Because that stuff is not internet sensitive.
that's correct.
And they're also
We
giving
own
the
a lot of
customers
ground floors
what
in
they
the
want.
city. It's been, and we
But
bust
urban retail, Freddie, is different.
Well, we start buying ground floors in the city when no one else wanted them. When there was a ground floor condominium and there was apartments upstairs, and it was very high yields. And now it's very low yields. But the rationale was it'll rent. I can never promise you what it'll rent for, but how many people walk by, how much money is in their jeans, and it'll rent. And that's the only equation, how many people walk by and how much money is in their jeans.
So here, with like 5 minutes left, how did my 4 gurus, these people who have seen recession, seen economic crisis, how do they see 2012 with regard to the economy and with regard to the real estate market? Mr. Orphanides?
Well, there's a lot of factors that are not in anybody's control, including all of us here in this room. But I believe that there are lots of people in Washington that are men and women of goodwill. I believe that the business community, which is not the enemy here, Wall Street is not the enemy. You know, we need to incorporate a sensitivity and an encouragement for the creation of the jobs that will help fuel our growth in our economy and demand and bring back a different kind of energy for the United States of America. This is a national crisis that cannot be ignored. No one group is going to win, and no one group should lose. We need to do a cumulative effort, and it starts with every one of us. You know, if we hold on to this cash and continue to hold on to it, as we've said, there's lots of cash on the sidelines. That cash not being committed is going to really not give us the opportunity for the creation of the jobs and create the demand in the future. Let's put the money to work. You can't, and Washington is now a little bit in the way. I think they're going to figure it out, and then we'll be able to move. Let business do what it does best, build and create what I would say the incentives and the opportunities for real growth in America. That's the simple statement I have.
Counselor.
Well, being a downtown person, I'm watching the transformation of what's happening downtown. That's a great example of it, Jim. With the building and the rebuilding of the World Trade Center, with the buildings starting to come up, within the next 3 to 5 years, you're going to see a new city downtown. And the transformation with the new transport hub and everything else, that's going to be an independent city.
It relates, and you were involved in this.
Yes.
Do you remember when Battery Park City was built?
That's my point.
I mean, Battery Park City was built out of the World Trade Center.
I was intimately...
And you were there, and you were intimately involved with the first ugly residential tower.
You remember.
That nightmare over there. But if you go into Battery Park
Don't
City
tell it to the people that live there.
No, it's fantastic.
That's what I see that's coming up now.
The transformation of Lower Manhattan into Battery Park
Absolutely. You're going to see a city within a city coming up.
So he's optimistic. I want Mr. Gould now.
You ask a question, what's likely to happen in 2012? That's not very long-term thinking.
2012, 2013.
My view is probably and I'm not an economist, so it's just free
You're
advice.
You're a very smart businessman, Fred.
It's free advice, and you get what you pay for.
I see you're not a lawyer.
No, I was a lawyer.
Was a lawyer.
He was, that's right.
But what you're going to have is, in my opinion, the economy is modest increments. You can't get better than a modest increment.
Yeah.
When you have this job problem, you can't get better than a modest increment. And referring to my friend Jimmy, who's a wonderful man, he said, quote, Washington has, quote, men of goodwill, and I dispute that entirely. I think most people in Washington simply there to get elected again, and his optimism about the government doing something correct, I don't share.
You got about 12 seconds.
Oh boy, I would like to be cautiously optimistic, but unfortunately, I don't see traditional financing opening up. I see tremendous conflict between traditional development and pursuing financing and REITs and funds and different things, and I feel the gun to my head, so
You're finished.
I'm finished. You know,
Here's what we're going to do. When the 11th season starts, and this show without Jim Orphanides would have never started 11 years ago, 10 years ago. But when the 11th season starts in September, I want you people back, because I want you to be with me as friends and also to provide insight. I'd like to thank Robert Levine, Fred Gould, Lenny Boxer, and Jim Orphanides. See you next week.
Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Giantomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling & Sterling, Stephen Napolitano, The Wickoff Group, Urban American.